am a survivor, and I will do whatever it takes to avoid my fate.
Buy $40 puts in Bluedorn, then sell $45 calls to offset the purchase.
That'll save us $10 million on this trade.
When an enemy's down on the field, you gotta finish him.
Let's talk about finance and business lessons from the first episode of Billion Season 2, based on my work experience at Goldman Sachs in New York City, and based on my work experience at the top hedge funds in the world. Now please subscribe and stick around, because at the end of this video, I'm going to grade the episode for Wall Street realism with a buy, hold, or sell rating. Two topics from this episode that we will discuss in a lot of detail are as follows. Topic 1, Bobby, Wendy, and Chuck all give incredible presentations in this episode, and we're going to discuss 14 tips on how you can create a career-defining presentation.
The entire hedge fund industry is under siege. We are already dead.
Topic 2 is Taylor's introduced in this episode, which brings next level investing strategies that are so much fun for me to explain so you can make more or learn how to protect your net worth. And Taylor discusses how to protect a long position in a company called Bluedorn Steel using what is called a zero-cost collar, which we will analyze and explain from scratch in detail as a way to cost-efficiently protect a position that a hedge fund owns.
What if you create a zero-cost collar? Use options to protect the sale.
Now, Marc Cuban used a somewhat similar option strategy when he sold his company Broadcast.com to Yahoo. And had Cuban not used options to protect his money, he would not be a billionaire today, which I'll explain in a lot of detail later on in this video. But first, let's talk about topic 1, which is presentation tips. Let's start with ways to begin your speech. Now, it has to be a powerful start or nobody will pay attention. And so Axe gives a really powerful speech to all of his employees. And he starts his speech by captivating the audience with storytelling, with this really powerful opening. And so tip number 1 of 14 for giving a great speech is to start with a story.
Millions of years ago, a meteor hit the Earth and brought on an ice age, and even the mightiest T-Rexes were reduced to skeletons.
Now, the way you start your speech is so important in order to get your audience undivided attention for the entire presentation. Axe then pivots to discuss fear and the upcoming doomsday scenario for the industry using the same meteor storyline, which is a brilliant way to captivate the audience.
A meteor is screaming toward this room right now, and all the rooms like it. The entire hedge fund industry is under siege.
So the start of his speech is really similar from a fear factor perspective to Gordon Gekko's Oscar-winning speech in the 1987 movie called Wall Street.
America has become a second-rate power. Its trade deficit and its fiscal deficit are at nightmare proportions.
I love that movie. Now, politicians start speeches like this as well by using fear with the current circumstances, which is tip number 2 of 14. And some of the best commercials start by showing fear, like Apple did at the start of their epic 1984 Orwellian Super Bowl ad. So what they do is they start by identifying the fear or the enemy, which way back then was IBM. And then what you do is you show the solution to the fear or the hero or whatever product it is that you are selling. In fact, some of the best presentations or YouTube videos use 3 elements in the title or the image, which are fear, curiosity, and desire. That combination works exceptionally well. Now, when you present, you need to define the problem, which is the enemy, and then show the solution, which is your product. And Apple also did this around 2007 when the enemy was Microsoft with this I'm a Mac and I'm a PC campaign. And right here, this dude is supposed to look like Bill Gates. And don't be afraid to go off script as well when you define the enemy, like communism versus capitalism, for example. And Reagan went off script in this clip in front of the Berlin Wall and said a few words that changed the world.
Mr. Gorbachev, open this gate. Mr. Gorbachev, tear down this wall.
And don't be afraid to pause and think and go off script and really speak from the heart as well.
As we mourn the loss of thousands of our citizens. I can hear you. I can hear you. The rest of the world hears you. And the people who knock these buildings down will hear all of us soon.
And I have to use one more real-life example, but this time in sports. Right after the attack in Boston, Big Papi said this by speaking right from the heart and going off script.
This is our city. And nobody might dictate us freedom. Stay strong. Thank you.
I love that guy. Now, us versus them works in presentations, as what it does is it creates brand loyalty and it's more entertaining. And so tip number 3 is the us versus them tip. Us is our product and them is the competition's product. And for Bobby Axelrod, the product is Axe Capital and the enemy is not only other funds, but also everything that Chuck Rhodes stands for.
The moment I let someone in a boardroom or a government office tell me what I can or cannot buy, I may as well close the shop, and I'm not closing the shop.
Now, Wendy also uses fear when starting her speech in this episode, but she also uses a prop. And since we're much more visual these days, starting with a prop can be a really, really smart idea for your presentation. And so tip number 4 is to use a prop.
Performance. That's a loaded word. Scary. A lot of pressure. That's why $2 billion worth of these babies are sold every year.
Using props and staggering statistics is also an awesome way to start a speech. And so tip number 5 is to use a staggering statistic. For example, if I'm giving a speech about personal finance, I can start with this football right here. And I can say this. Did you know that 78% of people that play in the NFL are broke within 2 years of retiring from the NFL? And so tip number 6 is you can also use a quote as well at the start of your speech. For example, Warren Buffett once said that we should spend what is left after saving instead of saving what is left after spending. And when it comes to quotes, I love using inspiring quotes to start my speeches, like this. Mark Twain once said, the 2 most important days in your life are number 1, the day you're born, and number 2, the day you find out why. We are here today to talk about what your passion is when choosing your next career. Then what you can do is you can transition to the rest of your speech. Now, in the description of this video, I included 100 of my favorite inspirational quotes to use when you start your next epic winning speech. And you can even combine props and quotes. And I once gave a speech, where's my prop right here? I have so many props in here, right? I once gave a speech on personal development. Let me turn this way here. I gave a speech on personal development and how destructive worrying is for our health. And I use this prop here, and I said, Dale Carnegie once said, our fatigue is often caused not by work, but by worry. So please stop worrying because God already knows what will happen. And as Winston Churchill once said, I once met a man on his deathbed who spoke about all the worries he had in his life, none of which came true. And that's a good segue. Let me put this down here. That's a good segue to tip number 7, which is whenever you forget what to say, you can use what I refer to as a crutch, okay? Like a quote could be a crutch. Or you can use transition words as a crutch while you think of what to say next, like in terms of, or moving on to. And then what you can do is you can look at your slides for the next bullet points, and believe me, nobody is going to know if you skip a bullet point on your slide. I promise you. Also, let me put this down too. When you're answering questions from the audience, in order to buy time from a crutch perspective, in order to buy time so you can think of the answer, what you can do is this. You can repeat the question or answer the question using a framework like the SWOT, S-W-O-T analysis, by saying something like this. That's a great question. Let me answer it with a SWOT analysis. So I'll kick it off with the strengths. The strengths are blah, blah, blah. In terms of the weaknesses, which are blah, blah, blah. Moving on to the opportunities, which are blah, blah, blah. And lastly, the threats. The threats are blah, blah, blah. And if you're rambling, which I do sometimes, you can use the crutch of the bottom line is whatever it is. Now, in this episode, Chuck uses humor and self-deprecation, meaning he makes fun of himself to start his speech, which is tip number 8. And this works exceptionally well. Being self-deprecating to make fun of yourself using humor, using humility as well, is an amazing way to get your audience to be on your side, as President Reagan did during a debate when everybody thought he was way too old to run for re-election.
You already are the oldest president in history, and some of your staff say you were tired after your most recent encounter with Mr. Mondale. I recall yet that President Kennedy had to go for days on end with very little sleep during the Cuba Missile Crisis. Is there any doubt in your mind that you would be able to function in such circumstances?
Not at all, Mr. Truitt, and I want you to know that also I will not make age an issue of this campaign. I am not going to exploit, for political purposes, my opponent's youth and inexperience.
Genius. Love him or hate him, that worked really well for him. Separately, if you make a mistake when presenting, please don't worry, because it instantly makes you more likable to the audience. And if I mess up, which I do all the time, I say something like this. Sorry, I just had a senior moment there, or the older I get, the better I was. And then you smile and then you move on. Tip number 9. The medium is more important than the message. Your appearance is important, of course. And we saw this in the first televised presidential debate back in 1960, and how Kennedy beat Nixon, as Nixon did not smile very much, as you can see here. Also, Nixon refused to put on stage makeup. So he was perspiring and he looked pale, tired, and a little bit nervous as well. And he had a 5 o'clock shadow beard. And appearance really, really mattered, because Nixon was ahead of Kennedy before that debate. And then immediately after the debate, Kennedy was ahead by 6%, which is a heck of a lot in politics. And some think that one reason that Obama became president was because of his epic speech at the 2004 DNC event. And politics aside, he was upbeat, energetic, he made eye contact with many people, and he was animated with his use of hand gestures, and he even used self-deprecating humor in this clip.
If you feel the same urgency that I do, who dares to defy the odds, the hope of a skinny kid with a funny name who believes that America has a place for him too.
Tip number 10. 3 words that will change everything for you when you present are less is more. Never have more than 3 bullet points per slide. And Steve Jobs talked a lot about simplicity in his products and in his presentations. And we can see the rule of 3 right here when Steve Jobs introduced the iPhone.
3 things: a widescreen iPod with touch controls, a revolutionary mobile phone, and a breakthrough internet communications device.
So the power of 3 is used in the best advertising campaigns, as you can see right here. Less is always more when you present. And please don't deliver a presentation. Deliver an epic experience, because it's so fun to be creative. And when you create your masterpiece, I want you to have fun and be at the intersection of technology and the liberal arts, as Mr. Jobs said. And when you can be creative in your profession, you no longer have a job, you have a passion. Now, when Steve Jobs came back to Apple in the late 1990s, he even used 2, not 3, he used 2 words to rescue Apple from near death with the Think Different campaign. Presentation tip number 11. Tony Robbins once said that motion creates emotion. You want to make eye contact with as many people as possible and stand out by moving a lot on the stage or in the audience, as Wendy does right here.
Because they bring reassurance that when the time comes, you can step up. Some of you take them.
And Bobby does this as well, with superb body language, eye contact, and he moves his hands a lot too. Again, as motion creates emotion in this clip from episode 1 of season 1.
But how we didn't give up, how we committed to each other, to our family. And I am so moved by how we've all flourished together.
Now, your delivery is key. As Maya Angelou once said, people will forget what you said, people will forget what you did, but people will never forget how you made them feel. Tip number 12 is to pause for effect like Bobby does right here.
All future conversations will be held in the presence of my Chief of Staff, Stephanie Reed. And I mean all. If you see me at the coffee machine, you wait until Steph is there before you pitch me the cream.
Accurate. Because Bobby Axelrod is actually based on Steve Cohen, as explained in this episode here. All communication has to go through an intermediary. And that's precisely what happened with Steve Cohen with all emails and forms of communication. In fact, when the government was investigating Steve Cohen's firm SAC, no emails sent to Steve or by Steve weren't first read by a lawyer. Tip number 13. I love this one. This is the 10,000-hour rule. Of course, the Billions actors practice their lines a lot, and you can too. In fact, here's a short clip of an early Steve Jobs interview before he practiced.
You need to tell me where the restroom is too, because I'm deathly ill actually and ready to throw up at any moment.
So for Steve Jobs' epic keynotes, he spent hundreds of hours practicing for them. And Malcolm Gladwell, who wrote this incredible book that you should read called Outliers. And in this book, Gladwell talks about how the people at the top of all professions practice for 10,000 hours, like Olympians do, from the young age up until they're 20 years old. Or like these 4 examples here of people that before they made it big, they practiced more than 10,000 hours. And they were all part of the 10,000 hour overnight success club. Now in the comments field, please let me know who you think these people are in these 4 images here. Tip number 14 is consider ending a speech with a thought-provoking question that sums up the presentation as Bobby does here. Of course, we won't be as confrontational as Bobby is right here.
And I will do whatever it takes to avoid my fate. Ask yourselves, are you?
One speech can change your life. You will learn to love public speaking. One speech. Oh, hey there. One speech can change your life. You can. Oh, hey, I'll be with you in a second, okay? You will learn to love public speaking. Oh, hey, actually, I'm practicing for my speech. Can I rehearse it with you and you can maybe let me know what you think? Okay, thanks. One speech can change your life and touch the hearts of so many people around you, whether you realize it or not. And this assumes you have no public speaking experience at all. No problem. I used to be terrified of public speaking, much more than you. I'd rather have been here than up there. For example, when I was in business school at Columbia University, as well as during the training program at Goldman Sachs, I asked more questions than my peers did because I was terrified of being put on the spot. But now I feel alive while giving speeches. You know, people might forget what you said, but they'll never forget how you made them feel. This course is not based on theory. It's based on real practical experience. I've given a TEDx talk, numerous keynote presentations, and graduation speeches in front of hundreds of people. I've given numerous business presentations, and I've been interviewed by many media publications. You will learn to love public speaking on the spot with no preparation. So that one incredible speech can be the bridge between where you are now and where you want to be. It's almost impossible to achieve all of your goals in life without learning how to master public speaking. Anyone that's had a significant influence on the world, from Dr. Martin Luther King to Malala, Bill Gates, or Steve Jobs, all had one thing in common. They've all had the ability to communicate with large groups of people. In this course, I will include 25 different templates for every type of speech occasion, from a personal speech at a wedding to a business presentation using Skype. This course will teach you everything there is to know about public speaking. One speech can change your life and the lives of so many people around you. Life all comes down to a few short moments. So how was that?
Guess it was okay, Dad. Can we go home now?
Sure thing, bud. All right, let's go. So I've got to take him home, but I'll see you in class. Thanks. So how was everything? Is that a good day? Topic 2. Taylor joins Axe Capital as Mafee's intern. And this is so awesome for these vlogs that I do because Taylor uses really advanced financial instruments to make money and protect money, which I really enjoy explaining. Here's how Taylor helps Mafee. Let's first analyze the problem with this trade.
I've got to dump 5 million shares of Bluehorn Steel at 40. Problem is, trades by appointment. No broker will take all 5 million and guarantee my price.
Accurate. When he says trades by appointment, what Mafee means is that the stock doesn't trade enough for Mafee to exit, meaning sell the position within a few days or even a few weeks. It's just not liquid enough, meaning it doesn't trade enough on a daily basis for him to sell the position quickly. And so he wants to sell 5 million shares at $40, meaning the position size is $200 million. And if we look at the Bloomberg screen that Mafee is looking at, we see here there's an OMON page, and OMON stands for Options Monitor. And we see here that the volume for this pretend stock is about 350,000 shares. And so Axe wants to sell 5 million shares. Alexa, what is 5 million divided by 350,000?
5 million divided by 350,000 is approximately 14.2857.
Okay, so it will take at least 14 days or about 3 weeks to get out of this position. And so when stocks don't trade very much, they are illiquid. And illiquid stocks own us in a down market rather than vice versa. And many hedge funds went bankrupt in the fall of 2008 when we were within 24 hours of bank machines not working. And hedge funds in late 2008 had massive redemptions, and as a result, they had to liquidate large portions of their funds. And as a result of this, when the hedge funds were forced selling their less liquid positions, they drove down the price materially. And before we talk about Taylor's solution to this problem, I humbly recommend being very conservative and trying to never own more than 10% of the daily trading volume of a stock so you can get out quickly if need be. So how is this calculated? Well, let's go together to Yahoo Finance and let's type in a ticker. For example, ABCA. And here we see it's trading at $3.81.5 per share. And if we scroll down here, we see that the average daily trading volume is 100,887 shares. Alexa, what is 3.815 times 100,887?
3.815 times 100,887 is 384,883.905.
Okay, thank you. All right, so the stock trades about $384,000 per day on average. So I conservatively recommend not owning more than $38,400 of this stock, which is 10% of the average daily amount traded. So you can easily sell within 1 day. Now, big hedge funds often own much larger than a 10% position relative to the average daily trading volume. So Mafee, who works on the buy side at a hedge fund, needs to sell 5 million shares. But he knows that if he gives the entire $200 million order to one broker on the sell side like Morgan Stanley, then this would be fiscally irresponsible because Morgan Stanley would know that Axe Capital was trying to sell a massive position and word could get out to the street. So his next step would be to do this instead.
So I've got 5 brokers selling $1 million each, and they don't know about each other.
That's logical. So what he does, he sends 5 million shares to 5 different sell-side firms in tranches of 1 million shares each to firms like Morgan Stanley, Goldman Sachs, etc. This is very logical because we assume that it's easier for a sell-side firm to sell 1 million shares instead of 5 million shares. But it's still an issue because word can still get out on the street that Axe is selling a lot of his stock. So here's Taylor's solution.
What if you create a zero-cost collar, use options to protect the sale, buy $40 puts in Bloodorn, then sell $45 calls to offset the purchase? You've got free protection at $40. The maximum downside is protected.
So Taylor recommends using options. So let's break this down. So a put means you buy an option that protects you if your stock goes down. And all you lose is the amount that you paid for the put. If the stock goes up a lot, the put is basically worthless. But if the stock goes down, then the put goes up a lot in value. But what if it costs a lot of money to buy that put? Well, Taylor's solution is to finance the purchase of the put by selling calls. Now, calls is the opposite of a put, meaning if you buy a call and the stock goes up, you make money. But if you sell, meaning you create or underwrite the call, then you get money from the sale of the call, which will finance the purchase of the put. Well, what if the stock goes up? In this case, you're going to lose money on the put that you bought, and you're going to lose money on the call that you sold, okay? But that's okay because you still own the underlying stock, which will go up in value. And while you're selling your stock, if you're worried that the stock will go down, that's okay. Because if the stock goes down, you're making money on the put you own and the call that you sold. And the process of buying a put and selling a call while you're long a stock, meaning you own the stock, is called a collar. And Taylor said it's a zero-cost collar, meaning it costs you nothing or very little, because you finance the cost of the put that you bought with money that you got from selling the call. Now, in reality, it's really, really hard to get enough liquidity on an option like this to hedge based on what we see here on this Bloomberg screen. And Taylor said buy a $40 strike put, which is here at a price of $1.75. And then Taylor said sell the $45 strike call. But the price here to sell is $1.50. So this is not really a zero-cost collar given the 25-cent differential. But to be fair and intellectually honest, it's never easy to perfectly match trades like this when liquidity is an issue. Now, if that bid-ask stuff is confusing to you, just think about it this way, and this is so silly, but you'll never forget it. Think about it this way. You're always getting the worst deal. If the bid-ask spread is $1.50 to $1.75 and you want to buy, you end up buying at the higher price, meaning $1.75. And if you want to sell, you end up selling at the lower price, which is right here, $1.50. And although there might not be enough liquidity to put on this zero-cost dollar based on what we see here on this pretend Bloomberg screen, we really don't know what other liquidity pools they might be in contact with, meaning Axe or Mafee or Taylor, that are not shown on this screen here. Now, selling a call is also referred to as writing or underwriting, meaning creating it to sell. And it's also referred to as shorting a call. And ignoring commissions or any fees, if we pretend that we bought the stock at $40 and we haven't put the option strategy on yet, then if the stock goes above 40, we make money, and if it goes below 40, we lose money. Now, while Axe Capital sells the long position, they are very worried that the stock sell-off might be extreme. Okay, they might be forcing the price down. And it might take them a long time to sell the stock because they own a lot of it. And this could easily drive the price down big time. Also, this is important, finance companies that manage over $100 million have to file by law a Form 13F with the SEC within 45 days of the end of a quarter. And if Axe Capital doesn't sell its entire $200 million position, and they still own shares, and it's publicly disclosed that they're selling shares, then this could really drive down the price of the stock because the market views Axe as smart money. Therefore, if they buy a put with a $40 strike, as Taylor says, then losses are limited if the stock goes down. Now, when you're long, meaning you own a stock and you own a put, it's called a married put. And a strike price of $40 for a put means if the stock goes below 40 bucks, then the put option is in the money. And the more the stock goes down, the more the put is worth. Now, the put might be expensive to buy. And that's okay because, again, we're financing most of the price of the put that we bought by selling, meaning shorting calls that have a strike price of $45, which are out of the money. And with the call that you buy, if the price of the stock, in this case, rises above $45, meaning the strike price, then it's in the money, okay? Meaning it's worth something if you own it. Now, because we're on the other side of that trade, meaning we shorted or sold the $45 strike price call, then we lose money if the stock goes above $45. But that's perfectly okay, as we're more or less protected from unlimited losses with the puts. So what happens is if the stock goes up a lot, technically you give up the upside profit from the stock that you owned because the call that you shorted will go up in price. But that's okay, because the whole point of a zero-cost collar strategy is it's an insurance policy to protect against a disaster scenario of the stock falling material while we still own the stock. Now, here's what the chart looks like of the profit or loss. First, here is the profit and loss on the stock itself. The x-axis is the stock price and the y-axis is the profit or loss. Now, if we add the put that we bought and the call that we shorted, we see that the loss is protected if the stock goes below 40 bucks because the put has a strike price of 40, meaning the put makes money if the stock goes below 40. However, the upside, as you can see here, is capped because of the call that you shorted has a strike price of $45. And the price that we paid for the put is mostly offset by the money that we collected with the call that we sold, hence the name Zero Cost Collar. Taylor is a hero with this strategy because of this.
But now you can be patient and you don't have to lean on the stock.
You're right. That'll save us $10 million on this trade.
So Taylor mentioned you can now be patient getting rid of this long position without worrying about leaning on the stock, meaning without worrying about driving down the price of the stock when you sell it. And Mafee says that this will save them $10 million on this trade. And what he means is the value of the long position is 40 bucks per share times 5 million shares for a value of $200 million. And since $10 million is 5% of $200 million, Mafee calculates that and this is not a perfect science, but he calculates that by selling the position, they would drive down the shares by 5%, meaning $2 on a $40 stock. But now with the zero cost collar, they don't have to worry about dragging the stock down when they sell it. Pretty smart of it. Now, I don't recommend this strategy for retail investors for a couple of reasons. First of all, it can be really tough to time these trades in terms of when you sell the stock and when you get out of the collar. And another reason I don't recommend zero cost collars for retail investors is because if we don't own more than 10% in a stock when it comes to the daily trading volume, then we can get out quickly. And if we don't want to sell the long, then buying a put will protect your downside. Now, options are often not that liquid, and therefore they can be very expensive if you have a massive position. But often, if your position is less than 10% of the average daily trading volume, then buying a put might not be too expensive. Now, I don't recommend shorting the call unless you have a lot of experience, and I say this with love of my heart, because you can get randomly assigned. And what that means is more or less this. Let's say that you sold, meaning you shorted a call, and John bought it. If Sally bought a call similar to the one that you sold to John, and Sally wanted to get out of the call that she bought from somebody else, then the Options Clearing Corporation can randomly assign you to be on the other side of Sally's trade if she wants to get out of the position, even though you never shorted, meaning you never sold the call to Sally. And you might be forced to sell the stock at the strike price, as confusing and as unfair as that sounds. And this can be disastrous if you don't own the underlying stock because you need to come up with the money to buy it. So let me give you an example. Let's say that you're short meaning you wrote or you sold a $45 strike price call. And let's say you don't own the shares that the call is based on. And let's say that the stock goes up big time to $145. Then you might be forced to buy the shares at $145 in the open market and then sell them at the strike price of $45 per share. This is a disaster. So please don't short, meaning don't sell or underwrite options. And please practice options with a paper portfolio. And then only buy puts and only buy calls. Please, 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 and I care. Never short options unless you have a lot of experience. And as Warren Buffett said, derivatives are weapons of mass financial destruction. So the married put position can protect the stock that you own. And you might be thinking, well, why not just sell the stock, Chris? I mean, why bother buying the put at all? Because in most countries, if you make money in a stock in less than 1 year, you pay much higher taxes. So let's say you're heading into year end and you're worried that the stock will fall and you don't want to pay taxes by selling it. You want to wait till next year. Then you can buy a put to help you save money on taxes and protect your position. Also, a lot of people that work at technology companies have 99% of their net worth in the stock of the company that they work at. And it might make sense to consider buying puts to protect your net worth if, for example, you cannot sell your shares yet. And this is exactly what Marc Cuban did. This is brilliant. So back in the late 1990s, Marc Cuban's company Broadcast.com was acquired by Yahoo for $5.7 billion. And so Marc Cuban got $1.4 billion in Yahoo stock. And Yahoo then was trading at $95 per share. Now, Cuban was not allowed to sell the shares of Yahoo for a while. So in order to ensure that he remained a billionaire, he set up a similar collar trade to what Taylor discussed. And Cuban put the collar trade on for 3 years. And people thought he was crazy because Yahoo more than doubled in price by January of 2000. But then, by 2002, Yahoo shares crashed along with many other internet stocks. And as a result, Cuban was able to retain about 90% of the $1.4 billion. Brilliant trade. And options can really help us profit or protect our capital from stock market volatility. Now, if you work at a technology company and a massive percent of your net worth is tied up in stock that you cannot sell for a long time, please call the investment bank that took your company public and ask to speak to the private wealth management department and ask them to structure a trade like Marc Cuban had in order to preserve part of your net worth. And valuing an option is much more complex than just looking at the strike price and when it expires, because there are so many other factors to consider, including implied versus historical volatility, dividends, interest rates, and so much more. And these can be quantified by analyzing Greek variables such as these right here. Now, to learn more about options, please check out my options course or my other finance courses and my MBA degree programs at this link. In my MBA degree program, I include the options course as well. Everyone needs to understand options, including investors, entrepreneurs, CEOs, and CFOs, because it affects all of our lives. And options can make us a fortune or help to protect us from losing everything. Now, when you invest in stocks, it's offensive as you're trying to make money. But when you invest in options, it's offensive and defensive as you can protect your money as well. And did you know that the size of the global options and derivatives markets is 6 times bigger than the size of all stock markets? In this course, I will teach you from scratch everything you need to know about options so you can take your investing game to the next level. I will also provide you with many comprehensive and fun to use Excel spreadsheets so that you can thoroughly enjoy, understand, and practice investing in options from scratch with me. Now, I've used options a lot in my career. When I worked at hedge fund giant Citadel, also when I worked at Goldman Sachs in the venture capital sector, and as a student when I did my MBA in finance from Columbia University, where I humbly got the top grade in my class in my options course. Now, I love to teach based on my real-life practical experience and to make options very easy and so much fun to learn in this very comprehensive course. And no prior knowledge of options or stocks or how to invest is required to take this course, as there are 3 tracks, meaning 3 different ways to take this course. There's a beginner track, a genius track, meaning an advanced track, and there's also a very comprehensive all track, where students can watch all beginner and genius level lesson videos and exercise videos, plus many optional lessons and exercise videos. Now, this course contains hundreds of videos, and there are so many ways to take and benefit from many or all of the lectures in this course. And I want you to think of me as your very humble waiter. And when you go to a restaurant, you only order what you're interested in on the menu. Now, in this course, the menu items include everything you need to know about options, as well as many additional topics like how to go long or short a stock, or options, long and short as well, or commodities or ETFs, or what are other derivative products like swaps, futures, forwards, and how to do fundamental or valuation or technical based analysis on stocks and companies, and how to learn statistics and data analysis from scratch in order to take your investing game to the next level. There's a lot to it. I even teach you in an optional section how to use Excel from scratch, as I've used Excel on Wall Street, in the consulting industry, and in the hedge fund industry and venture capital sectors as well over a couple decades. I'm clearly dating myself there. So this very comprehensive options course is several courses in one. Now, in this course, I provide you with mini Excel spreadsheets so you can learn everything you need to know about options, including an introduction to options, how to value options using 3 different valuation methodologies, and there's also more than 35 strategies in the third part of this course that we'll create together that use either 1, 2, 3, or 4 options in a single strategy. And what we're going to do is we're going to start with the basic building blocks of options, and we'll build upon what we've learned together using many very fun props until we have this incredible aha moment and it all makes perfect sense. Now, there's a 30-day money-back guarantee on this course, so you have nothing to lose and everything to gain. This will be easy and fun, and I'll see you in class. Thank you. Quick side note. The movie Wall Street from 1987 had a significant influence on all finance television shows and movies. It's kind of like what, I love music, but it's kind of like what Sgt. Pepper's means to contemporary musicians. And you'll notice that the stock that Taylor and Mafee talk about is called Bloodhorn Steel. And this is a very clever way that the writers of this episode likely paid homage to the movie Wall Street, particularly this scene.
Blue Horseshoe loves Anaconda Steel.
Let's talk about grading this episode for Wall Street realism with a buy, hold, or sell rating. Now, the episode did a great job of showing how you can start and deliver a very impactful speech, even though Bobby's content and delivery was a little bit overdramatic. However, the fear that he instills in his employees is really something that occurs at many hedge funds, as employees that have their own P&L, meaning profit and loss statement, are always fearful of losing their jobs. And large hedge funds are a little bit more passive aggressive when managing or motivating employees. But fear does exist because there are notable massive hedge funds that have literally 40% annual employee turnover. And that's why if you work at a hedge fund, please always have a plan B. Now, in terms of the zero-cost collar strategy from Taylor, the writing and use of this option instrument was brilliant. And I love the fact that the show is introducing more complex financial instruments, which will make these vlogs so much more fun for me to create. And I'm going to make one of these vlogs for every single episode. And so this was by far my favorite episode so far because of the introduction of advanced option strategies. Also, hats off to the writers of this episode for the inclusion of the Wall Street movie Easter egg. As a result, I'm going to give this episode a buy rating. Please subscribe, and I will see you soon in our next reaction video when we react to Season 2, Episode 2. Thank you.